Good evening, everyone. Live from Chicago, it's Thursday, November 16th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are so glad you are with us tonight. Normally the program's the second Thursday of the month, but we had so much data to analyze this month that I pushed it off a week, and so we're coming to you a week later. Before I begin the program, I just want to say that this show tonight is for my friend Greg. Now, Greg was a long-time listener of our program, was on here a lot asking questions. He's unable to be on tonight. So Greg, I'm dedicating this program tonight to you, buddy. All right, it's a November to remember. We're going to remember November because so much has happened already halfway through the month, all right? And we're going to cover that as we get into the program. If you are new to CB3 Live, please be sure to click the button that says subscribe to our channel and also click the bell so that you're notified whenever we go live or whenever I upload a pre-recorded video, which happens from time to time. I would suggest you follow me on Twitter or LinkedIn. Actually, it's X or LinkedIn or Meta, Facebook. I guess it's still Facebook, right? The company's Meta. Because I tweet almost every day and sometimes twice a day, depending on what's going on. We cover a variety of topics, although not every single segment is featured every month. This month, we're going to spend most of our time actually on the 12th segment. So I'm going to just mention up front here, during the course of this month, with the incredible volatility to the downside and then to the upside in the market, people are asking me questions and I'm going to answer them tonight. I want you to fully understand. Mostly, you may not get all the technical items, but here's what I need you to know. Our dual mandate for our clients, and that would be most of you, but not all of you. Some of you just listen because you like to hear me ramble, and that's great too. Our number one mandate is to protect our clients' portfolio. And the number two mandate is to grow our clients' portfolios. All right. Only difference there is protect and grow. And it's in that order that makes the difference. So the monthly review, we are in the month of November. Look at this chart. You'll see the gray is what past years have been from 1983 to 2019. Obviously 2023, we don't know yet. But in the last 10 pre-election years, this is what the market has done. And it's a pretty strong trajectory heading into the end of the year. So far, November is on track to continue to be strong, even though it didn't start out very well. At least it didn't get a good lead in from October, but it's doing pretty well so far, and we'll see if that continues into the rest of the year. Now, this chart is fascinating. Look at 1950 all the way down to 2023. Look at the year returns there. What happens for the rest of the year when trading day 218, which happens to be the first day of November. So there's 252 roughly, depending on how the calendar falls, trading days in a year. So there's a question mark down there at the end for 2023. We don't really know what this is going to be the rest of the year, but on average, it's been between 3.4 and 3.7% additional growth from where we are on the 218th trading day, the first day of November. I think that bodes well, and it's supported also by this chart showing you what has happened, the average change per month from 1928, so almost 100 years, all right? And not only that, cast your eyes to the left side of the chart, and you'll see that January is also strong, all right? So we have 4 months in a row that are pretty strong here. Let me say hi here to Keith. Keith, who came back from Lake Geneva today to be here for the show. Hey, Debbie from South Dakota. Hey, Martha, how are you? And Hossein, how are you? And there's others, I'm sure, but those are the ones that are checking in. So good to have you here, Martha, from Michigan. And we got several states represented. Okay, we have some new listeners in Missouri now, we know as well. So here we go. This chart you see every single show, and here we are near the end of the quarter. So we're in the fourth quarter of the year, which means we're reporting third quarter earnings. And we're 90% into this, and we're at 81%, folks. Those of you who have watched the program for a long time know that 73 is the average number. Consumer discretionary, 82. Staples, that's a surprise, at 86. Technology, 90. Consumer services, communication services at 89%. Really strong. So this has been a good year. And hey, Deb Billis from South Florida. I'm trying to catch everybody here as I see them up here on the right-hand side. All right. It has been a good year overall for earnings. Now, again, if you listen to the press, they will tell you that the earnings are getting weaker and the percentage of them is not what was expected, but they are still beating by more than 73%. We're at 80 something, right? Now, this could drop down next time I see you in December. Certainly it's possible that probably 99% of the stocks will be reporting, but considering everything that's going on in the world right now, I think that's a strong number, and I am fine with that. The employment scenario, also here, a little bit of a disappointment. The survey was for 180,000 jobs. The actual number for October was 150, so that's the red bar. But what do you see? Well, basically, since the current administration has been in office for 3 years now, every single month has been positive. And in fact, the last negative payroll report happened during the Trump administration. I'm just saying, folks, it hasn't been as bad as it may have seemed. Now, are we running out of steam here? Possibly. But does this look like a recessionary environment? It does not. All right. The unemployment rate, you see the spike there in 2020. Okay. It inched up just a little bit. So the survey was for a 3.8% unemployment rate. It was actually 3.9. That's just not enough to make a difference. Hey, Dr. J, hope you had a great birthday yesterday. All right. And there we are, that huge inverse V correction when we had this massive unemployment spike in 2020, and then it came right back normalized in 2023. Now, labor force participation, I should stop and just say, guys, I've got a little bit of a frog in my throat, and if I have to suddenly cough, I do have a mute button here on my microphone. So if you see me on camera laughing or coughing and you don't hear anything, it's because I've managed to get to the mute button fast enough. All right, so labor force participation rate down just a little bit, but here's the takeaway. We are, as an economy, getting through one of the toughest geopolitical times in our lifetimes. All right, certainly at least in the last 20 or 30 years since Vietnam and the Cold War. I mean, we have two major theaters, Ukraine and Russia, which is hardly anybody's talking about now. But with what's happening in Israel and obviously the Hamas thing, which is now metastasizing to Jordan and who knows, could metastasize further if Iran gets more involved or Egypt. But somehow the market is hanging in there, and all of these signs point to me to say there's still money participating, new money coming in. That's how we had this huge spike last week. You remember how the market was down, 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 and I'm going to talk about this in the last segment. And then just 5 straight moves higher, actually for a total of 8 up days in a row. Highly, highly unusual to have that many up days, especially with everything that's going on geopolitically. So participation rate, 0.1% less than what was anticipated. I don't see that as a problem. I just don't. So we get to U.S. policy, and you guys know this is always a little bit of a tricky section, but the truth is that politics lead to policy. What we care about is policy. Most of us on this call would love to avoid the politics because it's ugly. Even intra-party, when you hear the Republicans in their debate, spitting nails at each other. And of course, the Democrats do that if they were out of office, and, it's whatever they have to do to get elected, right? But politics leads to policy, which leads to personal impact, which affects our portfolios, and therefore I have to cover these topics. So fortunately, Congress averts a government shutdown, 87-11 in the Senate, with 2 abstaining, I'm sorry. And of course, President Biden will sign it, but all is not well with Mike Johnson. So since I've seen you, we not only lost the Speaker of the House, but 2 representatives from the House that were vying for Speaker could not get elected, and now the 3rd person did on the first ballot, probably because the Republicans were seeing just how silly they looked in this whole process. But even as this vote happened here, and of course this is the Senate, but prior to that, the House votes on it, Mike Johnson, the new Speaker of the House, lost the first round because those on the far right did not join with him. So how does this bode going into 2024? Well, it makes it really, really interesting. As you well know, yesterday, Xi from China came over and had a meeting with Joe Biden and many others, actually. If you follow the other news, I didn't put it up here, but he's sitting there with Tim Cook and Elon Musk. And of course, Elon Musk said, I don't have time for dinner, guys. I'm sorry, but I'll stop by for drinks. Can you imagine saying that when the premier of China is there? But I digress. When you're the world's wealthiest person, I guess you can do that. But some pretty big wigs out there in San Francisco, and we'll see where those talks go. Ray Dalio is a hedge fund guy, one of the most successful in the world. And he said, well, we're stepping back from the brink of a bloody war, but we're still having an economic war. Yeah, no kidding. I mean, that was kind of a duh statement. China wants to own the U.S. Anybody that thinks otherwise has just got their head under a pillow. All right. And in fact, it was, I think, Mike Pompeo, former Secretary of State, that said when he looked into Xi's eyes, it was just like looking into outer space. No emotional warmth, no nothing. This guy is just a cold, we're going to be the biggest entity in the world and we're going to use you to get there. His words, paraphrase, not mine. But I have to pay attention to that as a portfolio manager because it means at any moment, China could make a move that is going to affect us. All right. So that's the big items that are on the front here on the political scene. I do want to show you this again. I showed you last month, but look at what happened during World War I. I highlighted that in yellow, and then World War II. So there is some volatility, but you can see the 123-year history of the market. It really is just a blip. And it was the same with Vietnam. I didn't highlight that because you kind of get the idea. Same thing with Korea. In the Reagan era, of course, there were no real big skirmishes there. But one area that we look at as a monitor for what's happening in the economy during a war is what's the price of crude oil. And you can see the price before the Hamas attack. I couldn't find an updated chart here. This is showing crude oil at 84. Crude oil, which we trade in our Spec Op program, traded to $72 today. I mean, you would have thought a war in the Middle East, now granted, if it had been 30 years ago, it would be a different story than it is today. We'd see crude well above 100. And in fact, it did happen in 1991 with James Baker's famous line. If you don't know what that is, ask me and I'll tell you. It's pretty interesting history there with the U.S. and Iraq some 30-some years ago. But right now, we're pretty confident that crude oil is used as a barometer of what the tensions are. It's the fear. Call it the VIX for the war, if you will. And right now, just not seeing that world markets are concerned. When it comes to the Fed, I actually have Janet Yellen here, and she's not part of the Fed. She used to be part of the Fed, right? So she used to be the chairman. Then she moved over to the Treasury, staying in Washington, keeping that lucrative pension going for herself. But I digress. All right. She disagrees with Moody's negative outlook on the U.S. Our economy is fundamentally strong. I'm guessing you can hear the tone in my voice. We may be fundamentally strong, and it's astounding, really, that we are such a Goliath, that we continue to be strong, and I'm investing as if we are going to continue this, but our debt situation is spiraling further and further out of control. Notice I'm not saying it's out of control, because it's been out of control for decades. The current president has spent more money than any president in history, but that does not let President Trump, President Obama, President Bush, the junior and the senior, off the hook, nor Bill Clinton, although Bill Clinton had the last balanced budget in 1994, working with, you guessed it, Republican Newt Gingrich. The last time the budget was balanced, 30-some years ago, with a Democrat president and a Republican speaker. That's a big deal. Right now, Moody's, which is a credit rating agency, said, no, we're not going to give you our best rating ever. We're just not going to do it. Hey, Kay, glad to have you online, sir. And so what are the markets saying about the chances of another Fed rate hike? As you guys know, Fed funds futures, a lot of the futures markets, and I trade those in our Spec Op program, anticipate by buying and selling futures contracts, and there are wagers, if you will, placed on the chances of a Fed funds rate increase or decrease. And right now, if you look at the chart, you can look at the 27th of October. You can look at the 6th of November. I don't have anything more recent than that, but that's 10 days ago. That's still pretty good. Looking out into the future, you're seeing that there's less and less chance for an increase in the Fed funds rate. And that's good because it's pretty high right now. I mean, is it as high as it was in the 80s when Paul Volcker was there and had to come in when Reagan took office and, bring it down from 14.5 to 12? I mean, that was a major accomplishment. And then from 12 to 10, and it was crazy. But still, when you're used to no Fed funds rate, 0.25 for 10 years, this 5.25 to 5.5 has been very uncomfortable. So the Fed does not want to see that stay in place, and neither do we as Americans. So inflation, pretty simple story here. It's a downward story, all right? And one of the questions I've gotten over, several months this year is, can you tell us what the difference is between inflation and deflation? Well, yes, I can. And this is just a basic guide here. Look at inflation on the left-hand side, deflation on the right-hand side. So the price of goods and services increase in inflation. They decrease during deflation. On the surface, that would seem good, but not necessarily. All right. The things that we're buying are deflating, but so are our wages. So is the property of what most people have as their biggest asset, which is their home. Okay. Not something we want. All right. So explanation, the value of money decreases in the international market because if the dollar is inflating, that means other currencies become more valuable. The value of money increases in the international market in deflation. All right, back to the left-hand side, demand pull inflation, cost pull. These are three different names, and I don't want to go into details on this. And on the other side, money side, deflation, etc. The main thing to remember is that top definition. Inflation means costs of goods are going up. Deflation means they're going down. The effect, and this is what really matters, is unequal distribution of income. Those that are at the top do better than those who are at the bottom because those who are at the middle class and lower class, inflation affects them because they have less discretionary money. Even if they're borrowing it on their credit cards, eventually those credit card interest rates are going up, right, and inflation. So it just kills them, and it's just not a great situation. Unemployment level increases during deflation because less and less people are able to hire people because the cost of the widgets that the companies are making are going down. So which is worse? Well, a little bit of inflation is good for the country and the economy, as I just said. Certainly because we just want to see a slight increase in the value of our goods and services and, frankly, our assets, our homes, and that would be our portfolios too. Deflation is not good for the country and the economy, and that's why governments will do anything they can to prevent deflation. I don't think we're there anywhere close to it, but someone asked me for the explanation, and now you have it. You can go back and clip that little screen if you want to refer to it. It's important to understand the difference because a lot of the news shows just throw it around and say stagflation, inflation, deflation, just to kind of get you all worked up. And there's nothing to be worked up about. It's just plain data, okay? All right, so core CPI. We all know what Consumer Price Index is. It's going down. The survey was 4.1. The actual was 4.0. Only 0.1% difference. But it was big enough that the market really responded positively. The market doesn't need to see a 2% inflation rate. It needs to see that what the Fed is doing is working. And if the Fed is seeing what's working, they're going, you probably don't need to raise rates anymore. No one in the stock market wants to see higher rates because it makes fixed income more attractive and money exits the stock market and goes into the bond market or foreign currencies, etc. So that's what we're watching for there. All right. The actual change in Consumer Price Index, and I want to point this out to you. We just talked about deflation. We haven't seen deflation in years, and I'm going to go back to that actually. Let's go back to 2005. You don't say anything below the zero line, right? So deflation means that prices are dropping. So we've had inflation. We've been around that 2%. Look at that 2%. Just eyeball it across there, and then it's leapt up since 2021. And I've gone on and on about why I think that happened. Doesn't matter. It got up to 6.5. It actually, certain sectors of the economy were much higher than that. Healthcare costs, for instance, but dropping to 4, but never came close to deflation. But look here in 2020, as far as all items, that's not excluding food and energy, we came real close during COVID to having deflation because people were staying at home and they weren't buying, they weren't traveling, they weren't driving their cars. But being the resilient American economy that we are, it picked right back up, and now it's crossed below the food and energy line. So all items of the consumer sector spending is about 3.2 annualized inflation right now. If you exclude food and energy, it's higher. All right. The main thing to take away on this screen is it's dropping. The Fed wants to see it continue to drop. If it drops and we don't enter a recession, this is what it's called, and you've heard this phrase everywhere, a soft landing, not a crash landing, okay? And crash doesn't have to mean the economy, just shuts down like it did in 1929, but crash is not something we want. We want that soft landing. And if Jay Powell and his cronies can engineer that, that's how they will go down in history. You know what? Good for them. We'll see. So far, he has not handled it particularly well. You guys know on this section that I like to look at economic indicators. They're not moving the markets right now, but they're probably going to move it going forward. And so these are the good and the bad. Retail sales slowed down. See the little red blot there. Now, we've had negative retail sales since 2021. Remember the employment chart that I showed you. Let's go back. I'm not going to tick back there, but on the employment chart, remember everything was above. The last time it was negative was, the last quarter under President Trump. But ever since Joe Biden's been in office, and I'm just using this as a timeline, it's not meant to be a political statement. Okay, employment's positive. Sometimes it's rising, sometimes it's coming down a little bit, but it's above the zero line. All right, so retail sales not so consistent, but retail sales is a projection of what consumers are thinking. I know there's a ton of data here, but here's what's important. Adjusted for inflation, okay? So you look on the left side and say, well, this is good. People are spending money at health and personal care stores and food and beverages, electronics, that's all good. But if you adjust it for inflation, where are they spending it? They're spending it at the gas station. And that is because the price of oil Even though it has dropped, it has not been reflected at the gas station. Now, this will sound political. I do understand, but I've never been comfortable with the fact that when crude oil drops from 90 to 72, but I'm still paying $4.60 at the pump for premium, I'm not happy about that. They're just gouging. And this is where the whole electric mindset comes in. And it's going to be interesting to see how this plays out, because what the gas station operators are doing right now is holding on to those prices just as long as they can, even though their cost to buy the fuel is dropping, and dropping pretty significantly. All right. That's just what happens in a capitalist economy. But I thought this slide was interesting. People are paying more for gas than most other items for which they're paying. So consumer sentiment, I said this earlier, as long as the consumer in America is in pretty good spirits, they're going to spend money. 67% of the U.S. economy, you've heard this now for years, those of you that have listened to me for 15 years, live and on this show, 67% of the entire economy is based on the consumer. So when the survey drops from 63.7 to 60.4, this was when the market had a big downturn, that one big day where I think the NASDAQ was down 350 points, because nobody that's investing in the market wants to see, okay, consumers are bummed, they're not going to spend anymore. Well, it takes more than one datum, that's a single data point, more than one datum for people to be affected by that, all right? So consumer sentiment sags to a 6-month low. Why? Interest rates and the Mideast war. We don't really know how the Mideast war is going to play out. It seems to be a theater that's changing, and because I think it's closer to us, not geographically, which it actually is, but most of us know someone that's affected by this war, whereas maybe not all of us know someone that's affected by the Ukraine and Russian war, although I have a Ukraine and a Russian client, so that's an interesting situation there. But we'll see if this continues. If it does continue, it will affect home buying, which our home section's coming up here in just a little bit, and cars. So obviously, homes and cars, the two biggest ticket consumer discretionary items in the economy. We all want those to be strong, even if we're not in the market for a house or for a car. All right, we just want them to be strong. So credit card balances. People are back to putting up a lot of balances on their credit cards, all right? Look back to 2016, number of billions of dollars. We're at $1.3 trillion as Americans on our credit card. Now, we sat home and didn't spend much in 2020, but thought about it in 2021. Looks like COVID's going to be behind us, and now we're back to spending. So the good news is we're spending. The bad news is for those people that are letting their credit cards finance what I call a deficit lifestyle, there is a piper to pay at some point, and it's not a good place to be. So if you're one of my clients and we have a full financial review every year, I'm going to know what your spending is, and that's part of my fiduciary responsibility to you to talk about how you're spending. I'm doubting any of you are falling into this category, but be aware that debt is something that we want to avoid when the interest rates certainly are what they are right now. So the housing market, normally I talk about housing statistics, but really it's all about the mortgage statistics right now. So a $500,000 mortgage at 3% costs $2,108. And for the record, we had a 2 5/8 when we were in Tennessee. You guys have heard me say that before. Rates are a little higher now, just a little bit. We're not quite at 8, but look at the difference. And what do you get for that? Nothing. $2,500. That's money that comes out of your discretionary spending. This is one of the many, many reasons why people will say interest rates, Fed, stop it. We want low interest rates, because every dollar that this person is spending on interest, let's call it $2,500 or $1,500 a month, more, they're not spending buying widgets and other fun things for the home. 74% increase, all right? And actually now here in November, it costs a lot more to buy a home than to rent one. Now I track this. You can go back to 1970, and renting versus buying goes back and forth. We had a housing bubble when it was so much more expensive. In 2006, obviously, to rent. Rent's pretty steady. And when housing demand is super high, that's what happens. We had the same peak thing in 1981. You guys remember the housing bubble in 2006. We know what happened after that. Really bad. Really, really bad. And right now, we have the cost to buy at considerably higher than the cost to rent. Is this a bubble? I can't tell you. Bubbles can persist for quite some time, but it is something that I am watching, because depending on the amount of leverage that consumers have in their home, they will eventually be upside down unless during the great appreciation time, they didn't take out more loans against that. You know what I mean? Because during 2006, 7, it was like, oh, you can buy a home and then 3 months later you can go back and take 50 grand out of it, just finance your lifestyle. I'm not seeing the data that supports that that's what's happening now. And I'm glad, frankly, but that's what we're waiting to see. AI. All right, so I want to thank Larry again. I started following this about a year ago, but I didn't actually introduce a segment until about 6 months ago. And my friend Larry, who's a regular watcher of the show, said, you really got to have something on AI. So it's been a year now that ChatGPT has been out. And so here is the Chief Product Officer for Meta, where my son works, and Sam Altman, CEO of OpenAI. And here they are just talking about 1 year later. Now, the incredible changes that have happened since then, you'd think would be like, well, here we are a decade later. No, it's 1 year. 1 year. And the surprise success of this basically is called governments to say, we have to prepare people for potentially sweeping changes wrought by AI. Now, that's a friendly way of saying it might not all be good for you if you are employed in the wrong part of the economy that is easily replaced. I'm still not willing to sit here and say, we're going to lose 30% of lawyers and 42% of salespeople and 80% of map makers. I don't know that that's the case. We're still discovering it. But what we are finding, and this was a really interesting article, not that you're going to go out and read Quanta magazine like I do, but now you know that a computer has been able to beat Garry Kasparov, the greatest chess player in history. Although some people would argue Bobby Fischer was, but I digress, the American Bobby Fischer. But Garry Kasparov, the Russian. But now you actually have 3 AI engines, each trained to do certain things, converging. And I thought the graphic they used here was really outstanding. And so they can actually brainstorm with each other. And this is the big difference between just machines learning what we teach them. They're using what's called generative artificial intelligence, where they take in data and then they actually come up with their own solutions that is not part of the data set which they were fed. Does that make sense? All right, and a great place where this can play out is in games. And many people think the most complicated game of all time is chess. So I'm following these developments. Generative AI will be the most dramatic change in technology. It's affecting, I think I mentioned to you, music composing, graphic design, all kinds of things. And it's going to be interesting. I'm not threatened by it. I'm still thinking I'm going to have a job as long as I want to have it. Because again, if any computer had full knowledge of the market, nobody would take the other side of the trade. And there's not a market unless somebody's on the other side. So there's a little bit of safety in that. All right. So here we are. During this difficult time here, and I say difficult time because the market, I've got my hand on the desk tonight. Sorry if I feel like my Walter Cronkite mood here. Our job is to protect your portfolios, guys. It really is. And so I'm stating this for the second time. Our number one job is to protect our clients' portfolios. The number 2 job is to grow our clients' portfolios. There are times when it's easy to grow, and that is when the market is trending. Markets trend about 20% of the time. 67% of the time, they do nothing. Maybe it's 63. And that leaves about 14 to 16% of the time they're down. But when they go down, they're ugly. Really, really ugly. Not always, but many times. And those are the times we have to be in protection mode because we don't know where the bottom is. Our job, first and foremost, is to protect your assets. So let's look at what's happened here. We're going to go back, look at the bottom. You'll see September 2018, pretty standard market turn. And then all of a sudden, when we're at lifetime highs on February 17th, look at those huge bars where it says COVID crash. Boom, 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 boom. You know, there's one little green bar there next to the big red one that's like, well, we're going to try to come back. And it's like, no, there's no buyers. All right. During this time, we held on because this was such a short period and there was no precedent in my lifetime. You could go back to 1918, but you know, within a 100-year span, there was no precedent for this. What followed after that is the COVID recovery, and you can see that nice smooth chart. Now, a lot of people had been scared out of the market. We were not. We stayed in because this to me just screamed anomaly. But I know many very experienced traders, hedge fund guys, etc., that decided, no, we're going to exit and then we'll come back in. And you know what? They had decent years too. We had a fantastic year because we stayed in. All right. But I want you to look at the first blue bar there. It says Monday, September 20th, 2021. And now look over. Unfortunately, my logo's in the way there. Sorry about that. But that's today. Actually, it was yesterday. The market for 26 months is exactly where it was back on September 20th, 2021. But in the meantime, we had the 2022 cyclical bear market. And this was ugly. I want you to look carefully at the size of the bars. So going up, remember, you've heard me say this before, but this is good to remember. When the market goes up, it goes up on a staircase, just a little bit at a time. But when it goes down, it hits the elevator and slams down. And you can see it here. You can see those big red bars. We have to get out of the way of that, which means we take stops. And part of the reason I'm doing this segment is because one of my clients said, you know, I'm looking at my account and I'm seeing you're buying a stock at 100 and selling it at 92. And I'm seeing you're buying a stock at 80 and selling it at 76. Why don't you hold on until it comes back? Okay, well, what if it doesn't come back? Well, it always comes back. Really? Eastman Kodak? Did they come back? Did Lucent come back? Did Eastern Airlines come back? How about something just from recent history? WeWork, all right, employment agency. IPO'd at 500. They're trading at 14 cents. I can't do that to you. Now, it's one thing if all my clients were in their 20s and 30s and they could afford to just take flyers on these because they've got 40 more years to work. But most of you guys are around my age, maybe some a little older, some a little younger, and we're just not in that position like we were 20 to 25 years ago. I've known some of you that long, some of you on this call. All right, it's just a different time to invest. And so we do take protective stops. I'm going to show you this exact chart now with some stop levels put at the top. So you see the top of the market there where the green line and the red line intersect. That's January 4th, 2022. That was the last high in the S&P 500. Now in March, it tries to make a new high and it fails and it goes down. And so we're invested, but we now have to pull back and take some stops. And it comes back and tries to do it again. Look there in July, all right? And we're riding that for a while, but then eventually we have to pull out of that because it's a lower high. So you see the two red dots. The second red dot is a little bit lower than the first one. And they're both lower than the high of the market. I don't know what's up ahead. So to protect your monies, I have to take a stop. And that invariably means that if the market jackknifes and turns around, we're not going to keep up with the S&P 500 this year. Or that year, I should say, whenever that might be. And so once again, you know, every once in a while, a client will say, well, you just got to hold on. It's like, okay, well, here's the reason I don't. The bigger the advance, the bigger the potential pullback. All right. So let's look at, now you've been looking at weekly bars. Okay. So let me go back to this. These are weekly bars. So you can see September 18 to November 2023. So that whole page, because it's weekly bars, takes 5 years. But these are monthly bars. We're all the way back to 1995. So look at those tiny, tiny little bars there, right? Okay. And then during the secular bear market, secular means it lasts more than one business cycle. It was 2.5 years of pretty much straight down. All right. We can't be in the market fully invested during that time unless all of our clients are willing to take a 56 to 60% drawdown. Now, Charlie Munger, who is the vice president for Warren Buffett, when Charlie was a sprightly young man of 81, he's 99 now, said, you know what, you invest with us and you can't take a 56% drawdown, you're not really an investor. Okay, that's fine if all your clients are worth billions, Charlie, but mine aren't. I don't have a single client that's a billionaire, okay? So we have to trade differently. Look at the second secular bear market in our lifetimes here. Now, you can see the volatility gets greater during those red bars. So we're out there. And then was I a little slow to get back in 2009? Yeah. I mean, the market made its low 676.53 in the S&P 500 on March 9th, 2009. I'll never forget that data and date. All right, slowly making moves up. Notice that the green bars are bullish bars and the red bars are bearish bars. Remember, we go up the market in a staircase, we go down in an elevator, okay? So you can see nice move, and that's when, we have a great year, okay, and a great several years because the market mostly is going up. Look how volatile it got during the COVID crash, and even since then, you see the two red dots that I showed you earlier, okay? I can't just sit here and hope that we don't go down again when we are all at an age where if we lose 56% of our portfolios, it literally changes our lives. I can't do that. It's more important that I keep as much as I can because, again, number one, protect your portfolio, even if I give up some of the upside. Okay? So what this means is when the market's going down, I need to sell because I don't know when it's going to stop. And then if it jackknifes, we call it whipsaw in the industry, and it goes back on a buy, the little green circle there, I've got to buy again. Oops, that was a fake out. It goes down, got to sell again. And yes, this is very, very frustrating when you have multiple whipsaws like this. But the alternative is that. All right, and you just hold on through that, and now you're 68, 72, 80, and you're, whatever, $2 million portfolio is now worth $900,000. That's life-changing. I cannot do that. I just cannot do that. There is going to be, and this is a pretty major announcement for you guys. I'm going to show you something here. The best loser wins. What this means, and this isn't the major announcement. You guys saw this, those of you that went to the live fireside chat in September, and I'll be using it again in the January chat. We as money managers, if we're going to protect your assets, and I realize that could sound, if the letters weren't said exactly right, we're doing both, protecting your assets, right? Okay, a little humor there. We have to make sure that there's enough money there to grow this back when the market starts trending again. And it will. You can see back on this chart that trends, when they start and when they keep up, that's a secular bull market. I didn't mark it there because you can see the bear market ended. But we are essentially living for secular bull markets. We're in one right now, but this has been a particularly volatile one, not like those smooth bars that you saw last time or in the last chart. So I want you to look at this chart, and this is my semi-major announcement. This is an actual client account. Now, I had a client approach me, and I have 4 clients for whom I designed what I'm going to call a custom portfolio. And they said, we understand your risk management. We don't want to risk our retirement assets, but we have some discretionary money we want to set aside. And this guy started in 2017, and you can see the returns versus the S&P 500. They are dramatic. But what did I highlight? Not the upside, the downside. So in 2020, I actually performed about as well as he did, even though he was only in a handful of stocks. All right. But in 2022, he was up 280% from when he first started and dropped to up only, I realize only 120. So that's a 180% drop. Okay, so why would anybody want to do that? Because as you can see, in the long run, it ends up doing pretty well. So this has been something that I have made available to a few clients that are willing to understand the risk. They sign extra disclaimers. And you just have to understand the risk is very, very different than one of my managed portfolios. I myself trade what I just showed you there. And I want to just take a minute right now. Some of you on this call remember my mom, Jean Brown. And one of the most poignant memories I have was either, I don't know, third grade. I was 8 years old or 9 years old. So we're in the 60s here, guys. I got off the bus, I came in, got a snack, and I came into the living room, and here were all of Mom's friends playing a card game. Well, I found out it was bridge. And you remember the black and white Leave It to Beaver, where the ladies have the little hats on and the white gloves and pearls and everything. That was the scene. All right. And there were probably 10 of them in there, and they're playing. I guess they have to be 12 because there's 4, And they were laughing and having a good time. And they eventually got up and left. And I said, Mom, everybody seemed happy here. You guys are like gambling, right? Well, not really. Okay, well, what are you doing? Well, we bet a nickel. We bet a nickel on each game. Okay. So she started to pack up things, and I said, well, what would have been like if you were betting a quarter? She said, well, yeah, that would have been a different game. And a little more time went by, and so I just wanted to know. I said, so if you play the same game, but you risk $1, silver dollar. And she stopped and looked at me, kind of looked down and said, that would be a very different game. And so my takeaway on that is, it's one thing when you are doing something that's risky and you can afford to lose it all. I mean, definitely some women at that table went home with less nickels than they came in with, but it didn't matter to them. And I definitely got the sense from my mom, although I never asked her, that if she were playing for dollars, she couldn't do it. Now, it's 1960 something. I get that. It's not what $1's worth now. But here's the take. I just want to show this to you guys. I have decided, with proper disclosures and everything, if those of you that are frustrated with, I want to go back on camera, that are frustrated with the stopping, starting, with the fact that the market hasn't done anything in 26 months, and you're seeing these stops, which I'm doing to protect your capital. If you just want to have some money that's always in the market, and you can say it's buy and hold or buy and hope, then I'm willing to do that for you, and here's why. When we first started trading any of these stocks, they were billion stocks, worth of billions of dollars. Now they're all $1 trillion stocks. So we have buy and hold programs in the original FANG stocks: Facebook, Amazon, Netflix, Google, the Magnificent Seven, the Mama Group. You may never have even heard of all these, and the Emerging AI Group. And that's really my own there. So what I am saying to you is, if you want to take X amount of dollars, and I will tell you that I'm trading 2 of those with about, I think, 8% of our net worth. Okay. The guy that's trading that program, a little bit less than that. He's older than I am, about 6% of his net worth. If you came to me and said, I love that chart, I don't care about the volatility, I want to put my whole IRA in there, especially if it's 60% of your net worth, I would turn it down, and I'd have to literally turn you away as a client, because I always have to be a fiduciary, which is always acting in your best interest. That said, for some people that want the opportunity and they see these $1 trillion companies as stable and say, you know what, I just want to buy them and hold. And if you see something where you want to change the weighting values, a little more Facebook, a little less Nvidia, a little more Microsoft, a little less Tesla, I am involved in that part of it. All right. But there is no risk protection. It is buy and hold. It is buy and hope. Now, it doesn't mean that you can't say, liquidate, call me. I can't stand this. It's horrible. Yeah, of course I would liquidate you. But it's not going to be $1 traded in the same risk-adjusted manner that I trade CG and GI. 80% of Alice and my net worth is in CG and GI. Those programs are not changing. The problem is not the methodology. Those programs are structured to preserve capital first and grow capital second. Even CG, which is way more aggressive than GI. But for those who want to take the risk on a small portion of their net worth, and this is done on an individual basis with disclosures, written disclosures that we sign off on, you and I, we can do that for you. And in the past, I've just made it available to a few pretty well-heeled clients, but I'm going to make it available to everybody with the proper disclosures because I understand the frustration when the market's vacillating around and you're seeing, I'm in and now I'm out, I'm in and now I'm out. Well, you saw the chart for 1999 to 2002. I don't think that's going to happen again, but I do not have a crystal ball. Okay? I hope that's helpful, guys. Last time, dual mandate, protect our clients' portfolios, grow our clients' portfolios. Those are our two mandates in that order. Reviewing what we learned tonight. So the monthly market review, November, best month of the year, followed by December, followed by April, and followed by January. So we got a pretty good seasonal time coming up here. Employment scenario, we have unemployment just a tiny bit higher, labor participation rate just a tiny bit higher, not anything close to being concerned about. U.S. policy, we did see the debt ceiling debate, voted on, and that's going to be signed by President Biden. She met Biden and the bigwigs in San Francisco. I think that's good, softening the issues as far as what's going on in the country. The Fed, really the highlight was the Treasury there, saying that they don't like what Moody's did for the ratings here. Okay, but the Fed is watching this inflation, and I think that there's going to be it's going to be really hard pressed to increase rates any further than this. And I think the market's reflecting that. I showed you the inflation data that shows it's ticking down. U.S. housing market, really not the story, the housing. It's the mortgage part of the housing market that's the big story. Economic indicators mixed like they often are. Some positive, some negative. We'll see how that plays out into the future as we do every month. AI really pretty much coming along amazingly here. And when I have some real hard data to show you as it affects employment, I'm going to do that. And then, of course, the investment methodology. I thought it was important that you guys understand how we trade your accounts. And I went through this pretty thoroughly at the September Fireside Chat, which was live. I'm going to do it again in January. All right. But it's just important you guys know, and I'm bringing this discretionary program, we're calling it DS for discretionary, and it's something that you're going to choose. So you can pick a basket, you can have me monitor it, but it's going to be, we buy and hold, you can laugh and say buy and hope. This guy's done really well, but he suffered through a 180% drop, okay? But he was playing with nickels. Remember my mom's story. You're playing with dollars, $1968. It's an entirely different game. All right, let me check for questions here. Some of us you've known for over 50 years. That is true, Deb Billis. Yes, it is. Good strategy. Thanks, Doc. Andre from New York, how are you? What's your take on this anomaly? I don't have anything on Box right now. Write in the chat what you're talking about specifically. I mean, I'm thinking about, Dropbox or their competitor Box, but I think that's just BOX. I might be missing something here. And while you're typing that in, and if you don't get to it, shoot me an email and I'll cover it in the December chat. Hey, Charles Todd from Central Florida. What are your thoughts regarding the messages now starting to appear? U.S. debt clock, is this a hidden message? I don't know. I'm not really much of a, I don't want to say conspiracy guy, but the debt clock is showing that we're just in huge trouble. I mean, the only reason that we are able to do what we're able to do is because we are a behemoth on the world stage. So if you have a big enough caterpillar, and by that I don't mean the little one that crawls on the ground, you can pretty much tear down anything. They have these monstrous machines that can pretty much do anything. But at some point, they break and you got to get them fixed. And if you're still needing to clear the earth or whatever, I'm just making this up on the spot. It may not be the best metaphor. It's a problem. All right. So we have to pay attention to this debt, and we have to find an administration that's willing to do that. None in my lifetime since Bill Clinton have done that. And that's a real issue. So, Hossein, thank you. You with your approach to unprotected assets. Very good. I'm glad we can talk about that, Hossein, anytime you want. Keeps rising forever. So BOXX keeps rising forever. Okay. I will cogitate on that and have a better answer for you in December. How about that? But I hear you on the debt clock, Charles. It's frightening. It's just frightening. Next show, guys, the last one of the year. Can you believe it? I started in Nashville. I'm finishing in Chicago Thursday, December 14th. We will see you for that. In summary, we close every show with this. For we have not been given a spirit of fear. We are not going to be fearful on this show, and my clients, to the best of my ability, are not going to be fearful. But we have a spirit of power, love, and a sound mind. That's from 2 Timothy. Guys, I hope this was helpful. If you have questions, I know I covered a lot there about our investment methodology. Please send me those questions. CB3@cb3.com. Phone number on the website, 312-513-7486. We will finish in 3 weeks now, the last show of the year. You don't want to miss that. Christmas show is always a little special. And January, we'll be back to the live format 3 times a year, every January, May, and September. Those of you in the Chicagoland area, or if you want to fly in from somewhere else, we'll put you up overnight either at our place or Alice just freaked out. Not 15 of you. We can't have that many, but it's fun when we go live. It's definitely fun. It's a different environment. And so we're looking forward to that. We hope, Alice and I and our team, hope you have a wonderful Thanksgiving with your family. May God bless you richly. Thank each and every one of you for watching our program and being here with us. Greg, this show was for you. Thank you all. Thank you, Greg, for making this show special. Keep tuning in, guys. It's going to be a really interesting next year. God bless.